Welcome back to Daily Market Narrative, where we cut through the noise, sift through the jargon, and occasionally lament the fact that our crystal balls are still on backorder. Today, we're diving headfirst into the prevailing narrative that's got everyone from your Uncle Barry to Wall Street pros scratching their heads. The Great Interest Rate Cut Reevaluation. Or, as I like to call it, the Fed's "Are We There Yet?" tour, where the answer is consistently, no, not quite. Now, the story goes like this. For a good long while, the market was absolutely convinced the Federal Reserve would be slashing rates like a chef on a cooking show. Multiple cuts, everyone whispered. Then, like a bad surprise party, stronger than expected economic data started rolling in. Inflation proving to be less of a fleeting guest and more of a long-term squatter. And a labor market that just refused to take a nap. This, naturally, has led to a significant scaling back of those rate cut dreams. Suddenly, higher for longer isn't just a catchy phrase, it's the new mantra, a significant headwind dampening all that prior enthusiasm. So, where's the bull case in all this? Well, the optimists, bless their hearts, point to corporate earnings, especially from our tech overlords. Those big tech names are still pulling their weight, delivering individual stock catalysts that keep some segments of the market from completely face-planting. They're effectively saying, yes, the cost of borrowing might be higher, but our profits are so astronomical we can still afford a yacht, maybe even two. It's a testament to the sheer dominance of these companies that they can still find buyers even when the macro winds are blowing against them. But, and there's always a but, isn't there? This less accommodative monetary policy environment translates directly to higher discount rates for future earnings. In plain English, future profits are worth less today when interest rates are higher. It's like finding out your lottery winnings will be paid out over 50 years, and suddenly that private jet looks a lot less private. This means tighter financial conditions, cautious sentiment, and, as we've seen, a fair bit of volatility as investors frantically rejig their portfolios to this new, less forgiving reality. It's a delicate balance between corporate might and the cold, hard cost of capital. Speaking of cold, hard facts, let's talk technicals. The squiggly lines that dictate trillions of dollars. You gotta love them. Even after what some are calling the PPI shock, more on that in a moment, the long-term charts for our good friend SPI, that's the S&P 500 ETF, remain stubbornly bullish. And even on the daily charts, they're holding up surprisingly well. It seems the market, despite its occasional histrionics, still believes in the grind. The key level to watch, the one keeping the party from getting out of hand, is 640. As long as SPI stays above that, the general consensus is we're still on a slow, deliberate grind up towards 664. So, for all the volatility and narrative shifts, the charts are basically saying, chill out, we're still going up, just maybe not as fast as you'd like. Now, let's get to the headlines that matter, because nothing moves the market quite like a good, juicy news story. First up, the headline that gave everyone a little heartburn: wholesale prices rose 0.9% in July, much more than expected, CNBC. Yes, folks, the Producer Price Index, or PPI, jumped nearly a full percentage point in July, blowing past estimates of 0.2. This wasn't just a little hiccup, it was the largest monthly increase since June 2022. And here's the kicker. Core PPI, which strips out the volatile food and energy, also rose by 0.9. This tells us inflation isn't just about gas prices anymore. It's broad, driven by services, by trade, by machinery. What's the market impact? Well, it screams persistent inflation louder than a teenager at a rock concert. It means businesses are seeing higher costs, which they'll eventually pass on to us, the consumers. And if consumer prices stay high, it makes it incredibly difficult for the Fed to justify those rate cuts everyone was praying for. Expect higher borrowing costs and a general slowdown in economic enthusiasm. Next, a headline that probably made a few chip designers do a double take. Intel stock climbed 7% on report Trump administration is considering stake in chipmaker, CNBC. So, Intel shares surged after Bloomberg reported the Trump administration might actually buy a stake in the company. This isn't just about making a quick buck, it's about strengthening U.S. manufacturing, especially supporting Intel's planned factory hub in Ohio. The market impact? This is the government playing venture capitalist, essentially giving Intel a big vote of confidence and potentially a fat check. It signals a willingness for Uncle Sam to get directly involved in what are deemed critical strategic industries, like semiconductors. Keep an eye on this space. It could set a precedent. Then we head overseas for a dose of reality. China's economy slows sharply in ominous sign for outlook. Bloomberg.com. Oh, China, always keeping us on our toes. Their economy hit the brakes in July, with industrial output, retail sales, and investment all missing expectations. Industrial production grew at its slowest pace since November 2024, and retail sales growth was the lowest in 7 months. This deceleration is being blamed on weak domestic demand, government efforts to curb overcapacity, and, of course, the ever-present trade tensions. The market impact here is pretty straightforward. When the world's second-largest economy catches a cold, the rest of us start sneezing. It's a considerable risk to global growth, affecting demand for everything from commodities to luxury goods, and putting pressure on multinational corporations. Don't be surprised if Beijing starts rolling out more stimulus measures to try and perk things up. And finally, something that always gets the market's attention. Oil prices climbed 2% to one-week high as Fed rate cut, Trump Putin talks loom. CNBC. Yes, oil prices are up again, driven by two very different but equally powerful forces. First, the lingering hope of a Fed rate cut. Lower rates generally stimulate economic activity, which means more demand for oil. Second, the anticipation of talks between President Trump and Russian Putin. Geopolitics folks can move markets faster than a squirrel on caffeine. These discussions could influence global oil supply, especially concerning the situation in Ukraine and those pesky Russian sanctions. The market impact? Higher oil prices mean higher energy costs for businesses and for you at the pump, potentially fueling inflation and eating into consumer spending. It's a messy cocktail of monetary hopes and geopolitical chess. Now let's turn our gaze to a look ahead, because in this market, you always need to know what's coming next, even if it's just to prepare for the unexpected. Next week, we're basically playing economic detective with a slew of data points. We've got the NY Empire State Manufacturing Index, which gives us an early peek into how the manufacturing sector in that region is feeling, a good canary in the coal mine for broader industrial activity. Then get ready for a barrage of retail sales numbers. Total sales, ex-autos, ex-gas and autos, month-over-month, year-over-year. This is crucial because consumer spending is the engine of the U.S. economy. Are we still splurging or are we tightening the purse strings? The Fed will be watching this like a hawk. We'll also get import and export prices, which gives us clues about global inflationary pressures making their way to our shores. And for the industrial geeks out there, we've got industrial production and capacity utilization data, telling us how much our factories are producing and how much slack they have left. Finally, we'll round out the week with the Michigan Consumer Sentiment Report, including crucial inflation expectations. This is a big one for the Fed, as they want to see if the public believes inflation is coming down. If consumers expect higher prices, they're more likely to demand higher wages, creating a self-fulfilling prophecy. So keep an eye on those numbers. They're the tea leaves we'll be reading to figure out if the Fed's going to stay tough or finally wave the white flag. And that, my friends, is your daily market narrative. It's a landscape of cautious optimism, persistent inflation, geopolitical dance-offs, and squiggly lines that, against all odds, continue to go up. Remember, stay balanced, stay informed, and whatever you do, don't let Uncle Barry give you stock tips. Until next time, I'm Dave, and this has been your dose of market reality.